Hey everyone, welcome back to your channel. Today we need to talk about something huge. Layoffs are about to skyrocket, and the Fed has officially pivoted from worrying about inflation to bracing for unemployment. If you think your job is safe, think again. First, let's set the stage. A year ago, the Fed's communications were all about inflation anxiety. Today, as Danielle DiMartino Booth put it,
today, it's all about jobs. And that has caused a greater drag in expectations, whether you're talking about University of Michigan or Conference Board.
that quote says it all. The narrative has shifted, and so must your strategy. Why the shift matters. Inflation has cooled from 3-year highs, but the labor market is weakening faster than most people realize. In the year ended March 31st, there were originally 2.1 million jobs reported. Subsequent revisions have taken away 886,000 of those jobs, 41% of the total, in just 6 months. And we won't get full clarity on Q4 2024 data until June 4th, and Q1 2025 data until early September. As Danielle warns,
So all indicators are pointing at job losses having already begun.
that backlog in reporting means the Fed's decision makers are flying blind. They're reacting to what actually happened months ago, not what's unfolding right now. You've heard of hard data, official payroll numbers, GDP prints, PCE inflation, but those figures are inherently lagged. Soft data, surveys of business sentiment, consumer expectations, the Fed's beige book moves in real time. Right now, 66% of Americans expect unemployment to rise over the next 12 months. Danielle explains.
Once more than half of the population foresees a rising unemployment rate, it tends to be a self-fulfilling prophecy.
When 2/3 of consumers believe jobs will vanish, that belief influences hiring decisions, spending habits, and corporate boards. You can't tell them they're wrong when they're already seeing layoffs in their industries, on the news, and on help-wanted boards. April saw over 100,000 layoffs announced, and in the first 8 days of May, 8 major companies filed for Chapter 11 bankruptcy. Those aren't isolated incidents. Across transportation, warehousing, tech, and consumer goods, corporate distress is accelerating. Remember that spike in job postings ahead of tariffs, followed by a collapse once the front-loading ended? That's not a blip. It's a harbinger of what's to come. What the Fed said and didn't say. At the latest FOMC meeting, Chair Powell admitted he was not confident what the appropriate policy should be, openly acknowledging the Fed's uncertainty. Danielle called it petulance, pointing out that Powell disregarded his own data even as regional Fed surveys, like the Dallas Fed's latest, showed 60% of businesses wanted to raise prices, but 38% couldn't because customers can't pay more. Tariffs may push up input costs, but if companies can't pass them on, margins shrink, hiring contracts and layoffs follow. Unemployment forecast. We're already at a 4.2% unemployment rate, a cycle high. With consumer delinquencies climbing, credit card delinquencies are the worst they've been in years. Corporate CapEx plans collapsing and hiring intentions plummeting, Danielle's base case is straightforward. Recession and higher unemployment through the rest of 2025. It's hard to believe it's been nearly a decade since I left the Fed, Danielle said, but the mistakes they're making now are the polar opposite of those in 2020, and the fallout could be just as severe. Why it matters to you. Your job, your income, and your investments all depend on where the labor market goes next. As hiring freezes spread, even traditionally recession-proof industries can't escape unscathed. You need to prepare now. Update your resume, build your network, and consider defensive positioning in your portfolio. Actionable steps. Monitor layoffs in your sector. Set up Google Alerts for your industry layoffs and follow companies' earnings calls for guidance. Strengthen your safety net. If you haven't saved 3 to 6 months of expenses, start cutting non-essentials today. Rebalance toward defense. Consider shorter duration bonds and high dividend stocks or ETFs. Companies that can service debt and maintain dividends typically weather downturns better. Stay informed with soft data. Track consumer sentiment indices, University of Michigan Conference Board, and the Fed's beige book summaries for early warning signs. Key quote to remember. Your best offense is a great defense. In 2025, that means focusing on balance sheet strength, cash on hand, and income stability. Whether through secure employment or defensive investments, the Fed's switch from inflation to unemployment is your signal. Tighten your belt, shore up your reserves, and don't wait for the headlines to hit your doorstep. Layoffs are coming, and they could hit faster than you think. Stay vigilant, stay prepared, and I'll see you in the next video. Don't forget to like, subscribe, and share this with anyone who needs to hear it, because when jobs are on the line, everyone needs a plan. Bye for now.